Welcome to Griffonomics.
Thanks for having me back.
Imagine waking up tomorrow morning to find out that 40% of the people invested in your financial fund just demanded to be cashed out, like overnight.
Yeah, full panic mode.
Exactly. You're managing this portfolio, and suddenly there is a $1.4 billion run on the bank. You were forced to sell off massive chunks of assets just to cover the panic.
Which sounds terrifying.
Right. It sounds like a scene straight out of 2008. Well, today, we are undertaking a massive mission to figure out why this is happening right now. We are unpacking the violent collision between the massive $1.72 trillion private credit market
Huge market.
and the absolute deflationary force of artificial intelligence on the legacy software sector.
And it is a collision generating just a barrage of terrifying headlines. I mean, across the financial media, we are seeing real panic. We're seeing structural disruption. And perhaps most importantly, the total rewriting of a business model that Wall Street honestly thought was invincible just 3 years ago.
Yeah, they really did. And to figure out how we got here, we've brought together a stack of sources. We've got institutional strategic reports, internal market transcripts, macro financial analysis.
Just heavy hitters.
Right. And our goal for you today, the listener, is to cut right through that media hysteria screaming about a new financial crisis. We want to provide you with a granular, actionable investment roadmap.
Because you really need one right now.
You do, because whether you are heavily invested in the tech sector or, maybe you're chasing those high yields in the credit markets, or you're just trying to protect your broader portfolio from the next economic shock, you need to know what is actually hiding inside these financial black boxes.
Because when markets operate on a lot of assumptions and very little visibility, which is exactly what's happening right now, the natural human response is to sprint for the exit.
Which is the perfect place to start. Before we even touch the tech disruption side of this, we have to address the immediate panic causing those headlines. We are seeing a scenario where major institutions are suddenly not allowing retail investors to access their own money.
Right, the technical term is gating, and it is sending absolute shockwaves through the retail investment community.
The numbers from our sources are wild. So Blue Owl, which is a massive player in this private credit space,
Giant.
they recently saw a staggering 40% redemption request rate. Almost half the money in the fund wanted out immediately.
Wow.
Yeah. They had to liquidate $1.4 billion in assets just to cover that cash grab. And they aren't an isolated case either. Major prestigious funds, we're talking KKR and BlackRock, are now gating their investors. They're legally limiting the amount of withdrawals you can make. So naturally, if you turn on the financial news, someone is screaming, Subprime 2.0.
Right. A comparison that makes for great television, sure, but it fundamentally misunderstands the entire architecture of private credit.
But wait, I have to push back here.
Yep.
If you can't get your money out of a financial institution, isn't that exactly like Lehman Brothers collapsing in 2008? Think about it from the retail perspective. Imagine your local hometown bank suddenly called you up and demanded that you pay off your entire 30-year home mortgage today, simply because, I don't know, another customer at the bank wants to withdraw their savings to buy a boat.
Right.
You tell them they were out of their minds.
What's fascinating here is that the analogy you just made actually dismantles the 2008 comparison perfectly.
Okay, how so?
Well, the media is looking at gating as a sign of default or insolvency, right? But from a structural perspective, gating is a duration hedge. It's a protective feature, not a bug.
You're going to have to explain how legally keeping my money from me is a protective feature.
I know it sounds counterintuitive, but it comes down to the fundamental design of what a business development company or BDC actually is. When you put your liquid cash into a private credit fund, that fund does not just hold it in a giant vault waiting for you to ask for it back.
Right. They have to put it to work to get you that yield.
Exactly. They take that cash and lock it into 5 to 7 year, highly illiquid corporate loans. They lend it to mid-sized businesses to build factories or, buy out competitors. They literally cannot call up those borrowing companies and demand the cash back overnight.
Because the company already spent the money. It's tied up in their operations.
Precisely. If a fund tried to honor a 40% withdrawal request instantly, they would have to liquidate those 5-year loans on the secondary market at massive fire sale prices.
Which would tank the value of the whole fund.
Completely destroying the value for every investor who stayed in the fund. So the gating mechanism exists to match the illiquid nature of the underlying assets. It prevents a panic-induced bank run from destroying the fundamental value of the portfolio.
Okay, that makes logical sense. They can't just hand the cash back because the cash is currently acting as a loan. But And here's the big but: the core of the 2008 crisis wasn't just illiquidity, right? It was extreme leverage. Financial institutions were gambling with borrowed money.
And that is the second massive distinction the panic headlines are missing. Back in 2008, the major investment banks were operating at 30 to 1 leverage.
30 to 1.
Yeah. For every $1 of actual equity they held, they borrowed $30. They were leveraged to the moon. Today, regulators have legally capped BDC leverage at a ratio of 2 to 1.
That's a huge difference.
It is. And if you look at the actual data across the sector, most of the industry is operating at around 1.25x leverage. It is a completely different universe of risk.
The sources also point out one more crucial difference, which is the lack of derivatives. The 2008 subprime mortgage market was, at its core, roughly a $1.2 trillion problem. It was bad, but it was containable.
Right.
The issue was that Wall Street built a $62 trillion derivative market on top of those mortgages, all those collateralized debt obligations and credit default swaps.
Private credit simply lacks those financial weapons of mass destruction. If a private credit loan goes bad today, the loss is entirely isolated to that specific loan and the fund that holds it.
It's contained.
Exactly. It does not trigger a cascading derivative payout that bankrupts a global insurance company in London,
So the plumbing of the private credit market is actually relatively sound. It's not a systemic contagion waiting to blow up the global banking system.
The structure itself is holding up exactly as designed.
But that creates a massive logical contradiction. If the structure is safe and it's not a systemic threat, why are investors so spooked that they're demanding 40% of their money back in the first place? What triggered the stampede?
Well, the panic isn't about the structure. The panic is about the assets sitting inside the structure. And this is where we uncover the true Achilles heel of the private credit market right now.
Which is?
Highly concentrated software debt.
Yeah, the numbers here are just wild. According to the institutional data we reviewed, software loans make up a staggering 25% of all BDC portfolios.
Massive chunk.
It is. And if you look at the broader syndicated leveraged loan market, software accounts for roughly 16%. The credit markets are absolutely stuffed to the brim with loans made to tech and software companies.
And to understand the decay in the quality of that credit, we really have to look at when these loans were made. We are talking about the massive tech bubble of 2020 and 2021.
The LBO wave. We need to define that for a second. The leveraged buyout wave. This was that crazy era when money was basically free. Interest rates were practically zero.
The good old days.
Right. Private equity firms went on an absolute shopping spree, buying up software companies at sky-high peak market valuations. But they didn't use their own cash to buy these companies.
Of course not.
They used a tiny fraction of their own equity and then borrowed a massive mountain of debt to fund the rest of the purchase. And they borrowed that debt from these exact private credit funds.
It was a classic debt-fueled frenzy. And the terrifying consequence of that 2021 LBO wave is that today, roughly 50% of the software borrowers in this sector hold weak credit ratings of B- or lower.
B- or lower. For anyone not familiar with credit rating scales, that is pushing them incredibly deep into junk bond territory.
Very deep. So you have this massive concentration of junk-rated debt sitting inside funds that are actively marketed to retail investors as safe, high-yield income vehicles.
Okay, let's unpack this, because historically, Wall Street viewed the software sector as the absolute holy grail of business models. You build the software once, you sell subscriptions month after month, and you enjoy these beautiful 80 to 90% gross margins.
A license to print money.
Exactly. It was supposed to be the safest, most recurring cash flow on the planet. How did the safest cash flow suddenly become the biggest default risk?
It became a default risk because when you strap hundreds of millions of dollars of debt onto a company's balance sheet, the interest payments alone consume all of that beautiful 80% gross margin.
Wow, so there's zero breathing room.
There's no room for error. And that brings us to the core vulnerability of the entire software industry. A recurring revenue subscription model only works if the customers actually need to keep renewing their subscriptions.
Right.
It relies on the product itself not being rendered entirely obsolete overnight.
Which brings us directly to the spark that ignited this entire panic, the structural disruption of artificial intelligence.
Yep. If you want to know why investors want their cash out, look at the AI revolution.
If you look at the public markets right now, it is an absolute bloodbath. The SaaS ETF, that's software as a service, ticker symbol IGV, is down 25%.
Ouch.
Former market darlings, companies that were practically worshipped by Wall Street just 2 years ago, have plummeted 40% year to date. We're looking at absolute market carnage.
Analysts are actually going a step further. They're calling it the SaaSpocalypse.
Saucepocalypse. Catchy.
It is. And to understand the mechanics of why this is happening, we have to look at generative AI coding tools. Take Anthropic's Claude Code, for example. These AI tools have completely decimated the friction of building software. The institutional reports estimate they have effectively divided the cost to build in-house custom software solutions by 50 times.
Wait, 50 times cheaper. So if a
Yep.
company wanted to build a custom internal tool that, I don't know, used to cost them $1 million to develop, an AI agent can now help them build it for $20,000.
Yes. The barrier to entry has evaporated. Microsoft's CEO Satya Nadella recently stated that 20 to 30% of new code is already being written by AI.
That's incredible.
It is. This isn't some futuristic projection for 2035. This is happening right now on developer screens today, and it completely destroys the legacy software revenue model.
Let's break down why that legacy model is failing. The traditional SaaS model relies almost entirely on volume. They sell what we call human seat licenses. If you run a company with a customer service team of 100 people, you have to buy 100 individual seats or licenses of that software. It's a pure volume game.
But consider the impact of an AI native agent. If an autonomous AI agent can suddenly process the daily workflow of dozens of human customer service reps, the corporate client no longer needs those 100 human employees.
And if you don't need the human, you don't need the seat license.
Exactly. The volume collapses. Companies simply do not need to buy as many software seats. And because the cost to build new software has dropped so drastically, new lean competitors can enter the market and offer a better AI-driven service for a fraction of the legacy price.
It's a double whammy.
Yeah, the traditional pricing model is being crushed from both ends, plunging volume and zero pricing power.
It's like, imagine you're paying a massive premium subscription for a daily meal delivery service for your family. And then you wake up one morning and find out someone has installed a free, fully automated robot chef directly in your kitchen that cooks whatever you want. Why on earth would you keep paying for the subscription? You wouldn't. You'd cancel the meal delivery service immediately.
And that mass cancellation is exactly what the private credit investors are terrified of. Because if those subscription revenues vanish, those highly leveraged software companies cannot possibly pay back the massive loans sitting inside the BDCs.
So if these legacy software companies are bleeding revenue to AI, the natural next step for an investor is to check the balance sheet to see how much runway they have left. But here's the terrifying part. They can't. The books are completely sealed.
This is the opaqueness trap. It is the defining and currently most dangerous feature of private credit.
Explain this black box dynamic. If I own shares in a BDC, why am I flying completely blind regarding the companies I'm technically lending money to?
Because the software borrowers inside these funds were taken private by private equity firms during that LBO wave. By definition, they are no longer publicly traded companies. This means they are completely exempt from public reporting obligations. They do not file public 10K annual reports with the SEC. They do not host quarterly earnings calls where aggressive Wall Street analysts can grill the CEO about their survival strategy.
So the retail investors holding the private credit funds literally have no idea what is going on inside the specific companies they lent their money to.
None whatsoever. They know an AI tsunami is hitting the industry. They can see the 40% drops in the public SaaS markets. But because the BDC portfolios are black boxes, the investors have no way of knowing which of these private software companies are successfully adopting AI to expand their margins, and which ones are bleeding customers and heading straight for bankruptcy.
So human nature takes over. If you smell smoke in a crowded movie theater but you're blindfolded, you don't sit there and wait to see the flames.
Exactly.
You pull the fire alarm and run for the exit. That perfectly explains the 40% redemption request. They just want their cash out before the black box opens and reveals a bunch of defaulted tech loans.
And this opaqueness makes evaluating these funds incredibly dangerous right now, specifically regarding a very popular valuation metric called P to NA, or price to net asset value.
I'm glad you brought this up because a lot of yield-chasing investors use that exact metric to hunt for bargains. The logic usually goes, if a fund's stock price drops below its net asset value, it looks like it's on sale.
But in leveraged BDC vehicles, that metric is currently a dangerous illusion. We have to look at the math of leverage.
Okay, walk us through it.
Let's use a real estate analogy to make this tangible. Imagine a home buyer who puts down $100,000 in cash to buy a $1 million house. They borrow the other $900,000 from the bank.
Okay, so they have $100,000 in actual equity.
Right. Now, if the broader real estate market dips and the value of that house drops by just 10%, from $1 million down to $900,000, the homeowner hasn't just lost 10% of their investment.
Because they still owe the loan.
Exactly.
Excellent.
Because they still owe the bank $900,000, their entire $100,000 equity cushion has been completely wiped out. A 10% drop in the asset value resulted in a 100% loss of their equity.
Man, the leverage multiplies the pain.
Right.
And BDCs are doing the exact same thing, just with corporate loans instead of houses.
Precisely. If a fund has $100 in equity and borrows another $100 to reach that 2-to-1 leverage cap, it has a gross asset value of $200.
Right.
It lends that $200 out to software companies. If the value of those software loans declines by just 10% because of this AI disruption, the gross asset value drops to $180.
Okay, but they still owe the bank the $100 they borrowed.
Yes. So the net asset value, the actual equity belonging to the investors, drops from $100 down to $80. A 10% drop in the assets caused a 20% drop in the equity.
So relying on historical net asset value, when the underlying software assets are undergoing a massive, unquantified technological disruption, is a recipe for catching a falling knife.
In these highly leveraged vehicles, even a slight decline in gross asset value during this tech reset can severely damage the net equity. You just cannot trust the historical sticker price.
And as if the AI disruption and the opaqueness weren't enough, we need to connect this localized software credit crisis to the broader macroeconomic environment. Because even if a listener doesn't own a single private credit fund, this dynamic is going to ripple out and impact the broader economy.
The timing of this technological disruption could not possibly be worse for these borrowers.
Let's talk about the refinancing wall. We established that these junk-rated software borrowers took out these massive loans back in 2020 and 2021 when interest rates were sitting at practically 1%.
The free money era.
Right. Now, because these loans have front-loaded maturities, they are facing a massive wall of debt coming due right now. They don't have the cash to pay off the principal, so they have to refinance those loans in today's market. And today, rates are sitting at 5 or 6%.
Imagine a business that was barely scraping by when its interest payments were 1%. Now, their interest expense is essentially quintupling overnight at the exact moment their core revenue model is under attack from AI agents.
It's brutal.
The math simply does not work for a company rated B- or lower.
And this is all happening against a backdrop of severe, broader economic pressure. Look at the commodities market and our sources. Oil prices have spiked over $100 a barrel, currently sitting around $102. That is not just a pain at the gas pump. That acts as an unavoidable inflationary tax on the consumer.
Which sets off a brutal domino effect. High oil prices destroy consumer discretionary demand. People buy fewer goods. Companies sell fewer goods, which slows down the broader economy.
Everything grinds to a halt.
Yeah, and that persistent inflation makes the Federal Reserve hesitant to cut interest rates, which forces those software companies to refinance at those punishing 5 or 6% rates. And when companies need to cut costs to survive, the first thing they slash is their bloated software budget. It is a vicious compounding cycle.
We've clearly established this isn't a systemic threat that will crash the global banking system like 2008, but what is the actual macroeconomic impact? Give us the critical data point on the collateral damage.
Goldman Sachs ran the projections on this. They estimate that if this pressure triggers a moderate to severe default cycle in the private credit market, say around a 10% default rate, it would act as a heavy anchor on the broader economy. They project it would drag U.S. GDP down by 0.1% to 0.5%.
0.5% of GDP. That is massive. I mean, it's not a nuclear bomb, but it's a massive, persistent headwind that will affect corporate earnings, hiring freezes, and wage growth across the board.
It's a localized rot in the tech sector that drags down the aggregate performance of the entire economy.
All right, we have thoroughly diagnosed the disease. Now let's build the actionable investment roadmap for you. So what does this all mean? Based on the institutional sources, we are formally categorizing this sector as volatile selective quality.
Which means passive, broad market investing in these tech and credit sectors is currently highly dangerous. You cannot just buy the index, you have to be surgical.
First, a direct warning to you regarding the public tech markets. Beware of value traps. Just because a legacy software stock is down 40% does not automatically make it a screaming buy.
Absolutely not.
If its core code is fundamentally obsolete because an AI agent can do the same job for free, that stock is not cheap. It is fundamentally broken. Do not buy historical valuations in the middle of a technological revolution.
Unless a SaaS company can completely pivot its architecture to become AI native, it risks total obsolescence. However, the sources do highlight specific innovation survivors. There are defensive verticals within software that are actually highly insulated from this disruption.
The prime example being cybersecurity.
Right. Firms like Palo Alto Networks, ticker PanW, and CrowdStrike, ticker CRWD.
Okay, why them?
The logic here is straightforward. The democratization of AI coding tools exponentially increases global cyber threat vectors. Bad actors now have incredibly cheap, automated tools to write malicious code and attack corporate networks.
So the shield has to be as smart as the sword.
Exactly. This makes the complex adaptive defense services provided by top-tier cybersecurity firms absolutely mandatory for every corporation on Earth. They are the rare exception to the SaaS collapse.
Okay, that covers the equity side. What about the yield chasers? If I'm an investor who still wants the high income that private credit provides, but I don't want my equity wiped out by a defaulting software loan, what is the strategy for navigating the BDC landscape?
The strategy is a deliberate flight to elite quality. You must shift away from generic funds that gathered assets blindly during the 2021 bubble. Instead, you should willingly pay a valuation premium for elite BDCs.
So if broad market investing is out, I'm assuming investors need to look for low-leverage funds based on that house analogy we used earlier. But what else separates an elite BDC from a generic one right now?
It comes down to three specific criteria. First, skilled, massive underwriting teams. You need managers who can actually evaluate the AI risk inside private companies, not just look at historical cash flows.
Why would they need to know tech?
Yeah. Second, an above-average return on equity, proving they are highly efficient allocators of capital even in tough environments. And third, as you mentioned, ultra-low leverage. You want funds operating at sub 1.25x leverage to provide a massive equity cushion against any asset value write-downs.
The institutional sources specifically name 3 funds that fit this exact defensive profile. Ares Capital, ticker ARCC, Main Street Capital, ticker AAIN, and Capital Southwest, ticker CSWC. You might pay a slight premium for their management expertise, but you are buying yourself sleep-at-night security in a highly volatile market.
It is the absolute definition of selective quality. You avoid the highly leveraged black boxes stuffed with obsolete tech debt, and you partner with the underwriters who actually understand the shifting technological landscape.
Risk defined. Portfolio protected. We've mapped the macro environment, we've exposed the software debt nexus, and we've built the roadmap to navigate the AI disruption.
But before we go, I really want to leave you with one final lingering question to ponder as this technological revolution accelerates. We spent this entire deep dive establishing that AI agents are already eliminating human software seats.
Yeah.
But what happens to the global economy when AI agents advance to the point where they start negotiating, licensing, and financing their own software services directly with other AI agents? What happens when artificial intelligence completely bypasses these traditional human corporate debt and credit structures entirely?
A fascinating and, frankly, slightly terrifying thought to end on. Thank you so much for joining us on this deep dive. We'll see you next time.